Welcome. Yes?
Yes.
Teresa, this is your first time, yeah?
Yes.
You are worried that you will not catch up, but you are going to catch up.
I will try my best.
So don't be afraid. Eh?
Yes.
We've just covered 2 topics. But the one we are doing is the last bit of the topic 2.
Yes.
Then we are going to start topic 3 today. But you will consult, you can share the notes with you.
Yes.
Are you together?
Yes.
The videos. We will share the videos.
Yeah.
Why you send the videos?
Yes, I have them.
Did you have any challenge on anything there?
Yes, I have internet.
You have a challenge?
No.
Those things are so straightforward, so I don't think you should have a challenge. But I'm here to solve that.
Yes.
So let's then proceed from where we left. So we were looking at profit and loss. Profit and loss statement. Or here, we have listed them here. We have statement of comprehensive income in the same as income statement, the same as profit and loss. So in this case, we were looking at profit and loss, and it was Ramesh. So we had done, so this was as at 31st January 2006. So we are looking at that at that time. So already here, I told you here to put shillings. So we started with sales. Sales were 95.60 for those who are following. Then net cost of sales, which we have purchases. Purchases were 10 to 50. 10 to 50. So you can bring this on here. Then less purchase returns of 200. Then you get net purchases. Net purchases. Net purchases is 99.50. Again, you less it here 99.50. So it's not a must to put this one here. Then you are going to get you are going to get gross loss. Loss of, we had a loss of 390. Then add other incomes, add other incomes. Add other incomes, which was discount received. We had discount received. Discount received of 230. Then from there we have gross loss. Gross loss, which would be 160. Then from there, go back to your trial balance and now pick the expenses. Let's pick the expenses. We can continue from this other side. So let's expenses. Let's look at the trial balance and give me the expenses on that trial balance. What are the expenses on that trial balance? Those who were with me last time. Look at the trial balance. To look at that trial balance, we have capital, stock, cash, bank, M and company, RAM and Soris account, Chand and Soris account, purchases, sales, discount allowed, carriage outward. So the first expense we have there is carriage outwards. Carriage outwards. This is an expense. Of how much? 35 shillings. From there, we have yes, we had return outwards. Where do we put return outwards? Return outwards. If you return purchases, it becomes return outwards. Yes? You guys are lost. So I think here is where we were. This should be 300. This is supposed to be 300. Plus 200. So get me the loss here. $10,250 minus 300. How much are you getting? 10 to 50 minus 300. How much are you getting?
99.50.
Oh, it's 99.50. So it may go up just so 10 to 50 minus 300. Yes, so it is correct. It is correct. Thank you for that. Then which other expense do we have on that? Pick another expense that you can see from there.
Discount received.
Yes?
Discount received.
Discount received is an income. We've used discount received is an income, and we have used it here. 230 is here. So the other expense there is salaries and rent. So we have here salaries. Salaries was how much? 600. Then we have rent, 300. So how much is the total expense? Give me the total here. Take 35 plus 600 plus 9 plus 300. That is 935, isn't it?
How about the discount receipt? Discount allowed. Discount allowed.
Someone is talking.
Yes.
How about
discount allowed?
Discount allowed. Discount allowed. We have it where? Here.
Yes.
Thank you. Yeah, discount allowed. Thank you for seeing that. Discount allowed is an expense.
We can see that side.
It was how much? 100. So then now get me the total here so that you see how much loss we made. This is 900. This is one. It is 1035 here. So 1035. Yes. So now net loss. Get me the net loss, and the net loss will be negative 1035 plus negative 160. How much are you getting? This negative 1195. Take negative 160 plus negative 1035. How much will you get?
Negative 1195.
Thank you. So the net loss will be negative 1195. Thank you so much. 1195. So that's how to go about when you are talking about income statement or profit and loss or statement of comprehensive income. What you do, just as I had explained when you were starting, you pick the information from the trial balance. Don't forget that one. So from the trial balance, we are now to prepare profit and loss and what? And the balance sheet. So in this case, if you can see, you start with sales because in every situation, sales is the total cash inflow for a business that you use to now pay for the expenses after deducting the what? After deducting the cost of sales. So any question this part before we look at the balance sheet? Any question? Any question? Yes, Millicent?
I don't have any question.
Somewhere? Sam?
I'm okay. I'm okay.
You're okay. See, ndawapatia swali. Si mnasema mko sawa. I'll give you a question. Teresia, you have a question?
Ah, I have a question.
Yes.
I'm forgetting. About the carriage outwards.
Courage?
Outwards.
Yes.
Yeah, I've seen that you've captured them under expenses.
Yes.
Yes. Is it how about you deducting them from the purchases? Because like it's not possible.
Now carry it outwards.
I'm trying to see it on a different angle.
Yeah, I know. In fact, that's a very good question. When you talk about carriage outwards, this is the money that is spent to carry goods to the customer. For instance, let's say you have a hardware. Then you decide to transport cement to a customer who bought like 100 bags of cement from your hardware. So now, the cost of transport, that is fuel and everything in relation to transport, how will you treat it? Is it an expense or is it an income?
Well, it's an expense.
Very good. So that's why it is here. So every time you decide to transport goods to a customer, you will treat that expense, and you will treat that cost of transport as an expense. That is if you carry the goods to the customer. That's why we call it carriage outwards. Meaning you are carrying goods outwards of your business. That's why we call it carried outwards. The opposite is carried inwards. In fact, the question is so good and it has come at the right time. Carried inward is the cost that you incur whenever you are purchasing goods and bring them into a business. So if you pay for the cost of transport of goods that you bought that you bought from someone into a business, then that is called carried inwards. And carried inwards, we normally deduct it from here. We add it here because it's a cost of sales. So when you carry good into a business, that is carried inwards. So you come and add it here in the cost of sales with the purchases. So make sure you don't forget that one. So carried inwards is part of the cost of sales. Cost of sales. It's part of purchases. Carried outwards is an expense. So that should be clear to you. Is that okay? Is that clear, Sam?
Yes, it's clear.
Any other question? Yes.
No question.
Thank you. Now, I want us now to move and look at what we call a balance sheet. I want us to move and look at what we call a balance sheet. Let's move and look at what we call a balance sheet or statement of financial position. That's also a very important part of those questions. So let me capture this and share it with you. Now let's look at the next statement. The next statement is a statement that we call statements of financial position or balance sheet. We used to call it balance sheet long time ago. Balance sheet. So now, when we talk of a balance sheet, there is nowhere in CPA you'll find a paper that's not asking you to prepare a statement of financial position and statement of comprehensive income. You should know these things like your daily prayer, because this is the backbone of accounting. The moment you lose focus on how to prepare statement of financial position and statement of comprehensive income, you are a sure candidate of failure. So I want to emphasize that let's put a lot of effort to mastering how to prepare statement of financial position and the statement of comprehensive income. I'll give you the different names that have been used for them, but those two statements are a must in like 3 or 4 questions in your FFS. Now, the only thing that you need to know in the preparation of this document is this formula: A is equal to C plus L. A is equal to C plus F. In this case, what does A stand for? Yes, Sam. What does A stand for?
Assets.
Yes?
Assets.
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 Yes. Then what does C stand for? Yes, Millicent.
Capital.
Very good. Capital. And then L stands for what? Yes, Teresia.
Liability.
Thank you, liability. So in our statement of financial position or balance sheet, these are the key things that you have to include. These are the only 3 items that you have to be there. And then when you talk to about assets, we have 2 types of assets. We have long-term assets, and current assets. Those are the major classes of assets that we have. And then long-term assets, we also call them non-current. This is also called non-current assets. Non-current assets. Sometimes they are called fixed assets. They are the same thing. So these are the 3 things you find under this column, under the column of assets. And we have different names. We have long-term assets or non-current assets, or we call them fixed assets. Then current assets, they don't have any other name. Sometimes they are called non-fixed assets, or short-term assets. I'll give you examples of this. So now, on the upper part, normally we start with the assets, and we say that assets are the wealth. Assets are the gains the company makes in the course of doing business. Any wealth or anything that is owned by a business is called an asset. For instance, if you have a business and the business has got a building in its own name, a business like Safaricom has got so many assets. They have motor vehicle, they have buildings, they have the boosters. All those things are called assets. Everything that a business owns is called an asset. Even you in your personal capacity as a human being, some of you have got houses, some of you have got phones, some of you have got cars. All those are called assets. Same way in a business that has got such kind of items, we call them assets. They are wealth of the company. And those wealth, there are of 2 types. There are those that are expected to last long. For instance, land, motor vehicle, building, those are what we refer to as long-term assets, because we expect those assets to last for long in a business as they generate cash. Then we have Current assets. Current assets, these are assets. These are things that the business owns, but they're not expected to last long. For instance, stock. When your business has got stock, that stock is not expected to last for more than a year because no one buys stock to last long in their business. So if you have stock, let's say you have a hardware, and this hardware has got a stock of cement, metal bars, name them. That is what we call asset. Assets refer to items that are used to run the business. What you use to run the business is what we call an asset. Like stock, what you use to do business, or also cash and debtors. Those are what we call current assets. Then we said capital, this is the amount of money invested by the owners. I'll give you an example and you'll be able to understand. Now, money that has been invested by the owner is called an asset. And those who be in this class for some time, you understand how to go about this. So anything that the business, any money that is invested by the owners of the business is what we call capital. Because the capital owes you, the business owes you that money. So we call it capital. And any liability, any debt that is borrowed to run the business is what we call a liability. Also here, we have two types of liabilities. We have long-term liabilities, and then we have current liabilities. Now, current liabilities, just like current assets, these are liabilities that are supposed to be paid within 1 year. While long-term liabilities, these are liabilities that are expected to be paid in a period more than 1 year. So, for instance, if a business borrowed a loan from, let's say, Equity Bank, and this loan is supposed to be paid in the next 5 years, is that a long-term or a short-term liability? Yes, Teresa?
Oh,
Very good, it's a long-term liability. But again, if that business is owing rent, the business has not paid its rent, and the landlord wants the money to be paid. Is that a long-term or a short-term liability? If you are owing someone rent for your own business premises, how do you categorize that one? Yes, Millicent? Long-term or short-term? Yes? Yes, Millicent? Samuel, can you try? Yes? Who can
It's short term. It's short term because
yes, it will be a short-term liability because you're supposed to pay that rent within 1 month, yeah?
yes, within 1 month.
Any debts that the business owes, if they are debts that are supposed to be paid within in a longer period of more than a year, is long-term liability. Any amount that's supposed to be paid back in less than 12 months, that is a current liability. So that's how we have dissected this thing called balance sheet or statement of financial position. Don't include anything that don't fall into this. Again, this capital is a unique thing. So if you, after preparing your statement of profit and loss, the profit that you get, or the loss that you get, you have to bring it and add it to capital. Please. The profit that a business generates belongs to who owns the profit that a business generates. Yes, I want you to understand it from that perspective. If you have a business and that business has made some profit, that profit, who owns that profit? Your profit ni ya nani? Yes, yes, Millicent. Yes. You have a business, the business has been running, and you realize that after 1 year, you have a profit of, let's say, $1 million. That profit, it belongs to who owns that profit? Who should take that profit? Yes? Who Who can try? Someone?
Let me try. Let me try.
Yes?
I think it's the owner of the business.
Very good. The owners of the business own also the profit. Now, if the owners of the business own the profit, here, what else here is owned by the owners? What else is owned by the owners of the business? In assets, capital, and liability. What else do they own?
Assets.
Yes?
Assets.
No, asset belongs to the business, not the owner. If you have a business and that business has bought a motor vehicle, that motor vehicle is not yours. It will be registered in the name of the company. So don't say that the owners of the business own the assets. The assets belong to the business. Look at Safaricom. That building where Safaricom offices are doesn't belong to the owners. The building belongs to the company. So the only thing here that's owned by the owners is the capital. Because this is the money that was contributed by the owners to start the business. That's why, just as Sam has said, that profit belongs to the owners, we pick that profit and add it to the capital, so that we increase their money. We increase the amount of money they have in that business. If it is a loss, you deduct it from capital. If it is a profit, you add it on the capital. Are we together? So the loss that we got in the part that we just finished, the loss of 1195, will come and add it here on this capital. So let's go and finalize on that question, because now